You're probably paying your family's dental bill, your kids' classes, your prescriptions with money that already got taxed once. You earn it, the CRA took its cut, and then you spend what was left on something you had no choice but to pay for anyway. Sound familiar? Most people never even question it. It is just how it's always been done. Here's the thing though, your corporation has a legal way to cover those exact same costs before tax touches them, and almost nobody incorporated actually uses it. Not because it's just some secret, just because nobody ever sat down and explained it in plain English. Quick note before we go further. This is for education, not financial advice. I'm just telling you what I've learned running my own business. So take this as starting point and check the details with your own accountant or CPA before you act on any of it. So why does everyone miss this? It's not some obscure loophole buried in the tax code. It is a benefit that CRA recognized for years. It's just explained badly, wrapped up in accountant language nobody wants to read. Most incorporated owners either never hear about it or they hear about it once, shrug and assume it's too much of a hassle. That's the gap we're closing today. Quick note before we dive in. This isn't a sponsored video by Wealthsimple, but I do use Wealthsimple Tax to keep my corporate and personal filings simple. You can earn $25 by using my code. The link is in the description below. So what actually is this thing? It's called Health Spending Account or HSA. The CRA's official name for it is Private Health Service Plan. So don't be thrown off if you see it written in that way too. Here's what it actually does. Your corporation pays for your eligible medical, dental, and vision bills, and it writes that off as a business expenses, and you get reimbursed and you don't pay any cent of tax on it. Now compare that to what most people already do even without thinking about it, which is claim medical expenses on their personal tax return through the medical expense tax credit. That only gets you back of slice of what you spent, not the whole thing. An HSA were completely different. Your corporation deducts the full cost as business expense, and the money that lands back in your pocket isn't taxed at all. Let's put real number on this using Ontario, since the rate shifts a bit by province. Say your family racks up to $1,000 in dental work this year and you already passed the threshold to claim it personally. So call it 20% combined. That's about $200 back. The other $800 still comes straight out of your own after-tax pocket. Now run that $1,000 through a corporate HSA instead. Your corporation deduct it as business expense and then you get entire $1,000 back, tax-free, no strings. Same bill, same family, but one pet quietly costs you $800 more than the other. Just keep in mind this rate shift a little year to year and by province, so treat the concept as solid and double check the current number with your accountant. Multiply that gap across every year and you run your business, and that's exactly why this video worth a few minutes of your time. Okay, so who actually qualifies for this? This is the part that people skip past, and it's the part that bites them later. First, you need to be incorporated. Sole proprietors generally cannot use this unless you got arm's length employees, meaning people working for you who aren't your spouse or your family member living under the same roof. Second, and this one trips a lot of people, you actually need to be an employee of your own corporation. That means you're on payroll, pulling T4 income, not just taking dividends at year end. I know it sounds like technicality, but it's this technicality the whole thing hinges on. Here's the actual cause and effect. So pay attention. If you're paying yourself dividends only, the CRA doesn't consider you as an employee of your own company, even though obviously you're the one who running the show. And if you're not an employee, there's no employment relationship with your corporation to be providing a benefit in the first place. So instead of clean tax-free reimbursement, the whole plan can get reclassified as shareholder benefit, and that's taxable, which means you have gone through the whole setup, paid your admin fees, submitted your receipt, and landed right back where you started. Except now you've got extra paperwork and maybe a reassessment to deal with. Even a small salary layer on top of your dividend can be enough to fix this, but there's no magic minimum number that guarantees it. That's exactly why this is a conversation to have with your accountant before you set anything up. Your specific pay mix decides whether this works cleanly or blows up in your face. Quick note before we move on, drop a comment whether you paid your health expenses through personal or through the corporation. I'm curious what most common. So what actually counts as eligible expense here? I won't read you the entire list, but here's the gist. Dental work, vision care, prescription therapy, paramedical stuff like physio or massage from a licensed provider, and many more. It is basically the same category of expenses that CRA already accept for the personal medical expense tax credit, just reimbursed through a smarter, more tax-efficient path. Cosmetic and anything that's not medically necessary doesn't count. So no, you can run a gym membership or spa day through this and call it a healthcare. If this is useful for you, please hit like and subscribe so you don't miss what's next. Alright, I'll walk you through how to set it up. Step 1. Confirm if you're eligible. You're incorporated, you are paying yourself at least some T4 salary, not dividend only. Step 2. Pick third-party HSA provider instead of trying to run this yourself. They handle the CRA compliant paperwork and process your claims for a small admin fee. Usually it cut whatever gets reimbursed. That fee is basically what you're paying for airtight documentation and given everything that's riding on this being done right. Most owners find it worth every dollar rather than trying to build paper trail on their own. Step 3. Set your annual limit per person or per family. Think of it as your budget for the year, not some fixed premium you lock into no matter what you actually end up spending. Step 4. Get the plan properly documented. If you're the sole shareholder and employee, this needs to show up in your employment arrangement, not just some fake understanding you have yourself. Step 5. Pay for eligible expenses as they show up. Submit your receipt and get reimbursed tax-free. Honestly, that's the whole process. It's not complicated. You just need to actually get set up properly instead you hoping it will sort itself down the road. A lot of owners put this off for years thinking it will be a headache, and then they set it up in afternoon and wonder why they waited. If you're already thinking about how something like this fits into your bigger tax picture, that's exactly what Wealthsimple Tax helps me to keep organizing at filing tax time. Corporate and personal in spot. Link is in description below. It's not the star of the show here, just a tool genuinely I use. Now let's talk about where this actually goes wrong, because this is the part that matters way more than the exciting stuff. If you're paying yourself dividends only, this doesn't work as is. You need to fix your pay mix first, and that's a bigger conversation with your accountant. The CRA has publicly warned about HSA schemes, specifically ones marketed to sole proprietors who don't have arm's length employees, promising some clever workaround that for eligibility rule. If anyone tried to sell you that workaround, that's a cue to walk away, not to lean in. You can technically administer your own plan, but I really wouldn't recommend it. Bad documentation is the #1 reason these plans got challenged when the CRA takes a closer look, and by the time that happens, it's a lot more expensive to fix than it would have been just to set it up properly from the start. There's also a real cost trade-off worth naming here. The admin fees and time spent on paperwork generally eat into the tax savings, so this makes most sense once your medical and dental spending is big enough that the savings clearly beat the fees, not the odd dentist visit here and there. And to be crystal clear, this is a legitimate CRA recognized deduction when it's done properly. It is not a loophole, and it's not something to get creative with. The whole appeal here that it is boring, well documented, and completely by the book. So here's the recap. An HSA takes medical spending you're already doing, paid with money that already been taxed, and turn it into pre-tax deduction through your corporation instead. But only if 3 things line up. You're incorporated, you're on payroll with at least some salary, and the plan is properly documented through a real provider. In your next move, before you set any of this up, go check your salary and dividend mix and your typical medical spending with your accountant. This whole thing only works if that foundation's actually right, and getting it wrong ends up costing you more than just never bothering would have. And since this whole strategy depends on how you pay yourself in the first place, that is exactly what I'm covering next: how to pay employee salary. Subscribe so you catch it. I will see you in the next video. Bye.